Okay, this is in response to great inquiries by Idaric and Juggy. Here we go. So, agricultural sea variable, El Niño 2026. Fry's earlier Hormuz divergence model work, we've shown the most profitable trades aren't in obvious first-order effects. The A variables that every Bloomberg terminal is already pricing. The real edge is in the C variable, the downstream consequence the mark hasn't fully connected yet. El Niño 2026 is exactly that. El Niño 2026 is exactly that. National Oceanic and Atmospheric Administration, from now on I'll be saying NOAA, has placed an 82% probability on El Niño emerging between May and July this year, with a 96% chance it persists through winter into 2027. Some models are flagging a potential super El Niño, a +2 anomaly event, matching the intensity of the 2015-16, the strongest of the 21st century so far. We've already got the Hormuz thesis active. Fertiliser costs, ammonia, urea, all under structural stress. Now we're laying a second, entirely independent force function on top. Climate-driven agricultural supply disruption. Two variables, same price direction. El Niño is a natural climate cycle driven by warming of sea surface temperatures in the eastern equatorial Pacific. When those temperatures rise above 0.5 degrees Celsius above normal, it acts like a boulder dropped in a stream, disrupting atmospheric circulation globally, shifting rainfall patterns across every continent simultaneously. The critical thing to understand as traders is the lag. The climate event and the market impact are not simultaneous. Historical analysis shows a 6 to 12 month lag between peak of the ENSO event and the peak of the agricultural supply disruption. This is why the trade opportunity exists. Markets react to headlines, but the real supply impact arrives later. This is an incredibly important message to focus on. The timing. Okay, Fryer is still learning about how to narrow down the timing. Notion of 2026 as being unusual. NOAA quietly replaced its 30-year ENSO measurement index in February 2026. They created the Relative Oceanic Niño Index because the old baseline no longer cleanly separated the natural cycle from the permanent warming trend. The ocean is running hot even before El Niño layers on top. Okay, El Niño's regional playbook, South America. The key insight here, El Niño does not affect South America uniformly. Drought and flood occur simultaneously in different regions. This is not unique. It certainly happens in Australia. Different parts of the country are in drought, while other parts of the country, not far from there, are being flooded. The biggest mistake traders make with El Niño is treating South America as one homogeneous region. It's not. El Niño creates droughts and floods simultaneously in different parts of the continent. The northern and central regions, the Brazilian Amazon, the Cerrado, Pantanal, Central America face drought. The Cerrado is particularly important because that's where Brazil's agricultural expansion is concentrated since 2019. Meanwhile, the southern cone, southern Brazil, Uruguay, Paraguay, northeastern Argentina gets excessive rainfall, flooding, waterlogged soils. This damages soil quality and disrupts the harvest window. And Ecuador and Peru both face coastal flooding and highland water stress. The 23-24 event produced both in close temporal sequence, and authorities now treat that as the baseline expectation. The market prices the headline without understanding the geographic nuance. That nuance is our edge. Fry's C variable framework. Why the market prices A and misses C basically every time. And again, as Charlie Munger says, the big money is not in the buying and the selling, but in the waiting. That is so true. The A variable is what the market prices immediately. El Niño watch announced, soy futures move, corn moves, Bloomberg runs the headline. Every institutional algorithm picks it up. By the time you read about it, it's in the price. The B variable is the secondary effect. Fertiliser costs rise. Food CPI data reflects higher commodity prices. Still visible with modest research, but you're sharing the trade with many others. The C variable is where our edge lives, the specific mechanism by which El Niño creates a sugar supply deficit via drought in India and Thailand, the world's second and third largest producers, while India bans exports. And coffee, Brazilian stocks already at historic lows from the 24-25 drought. And a second climate event arrives on top. Preloaded spring, enormous potential energy. The beautiful thing about the C variable is timing. That 6 to 12 month production lag means the trade is not crowded when you enter. And for us, there's the Hormuz layer, an entirely independent forcing function pushing in the same direction. Two independent variables, one directional trade. It's the timing. Sugar. The supply picture is flipping from surplus to deficit. El Niño tips the balance. The global sugar market is flipping from surplus to deficit. In 2025-26, a surplus of around 2.3 million metric tonnes. Comfortable, nothing dramatic. In 2026-27, virtually every major analytical house is calling a deficit. The International Sugar Organization projects production falls to 180 million metric tonnes, down 1.1% year on year, resulting in a 262,000 tonne deficit. That's before El Niño has its full effect. StoneX calls it 550,000 tonne deficit. Datagrow has gone to minus 3.17 million metric tonnes. Kazankow has gone from 3.4 million tonne surplus estimate down to 1.1 million. These are serious, credible commodity analysts converging on the same direction. Three specific drivers. First, Brazil. Citigroup projects output of 39.5 million metric tonnes, well below Conab's 43.95 million metric tonnes, because mills are diverting cane to ethanol as petrol prices surge. The percentage of cane crushed for sugar fell from 44.7% to just 32.9% year on year. That is a massive structural shift. Second, India. The government has banned all sugar exports until at least the 30th of September 2026, when the world's second largest producer slams the export door shut. That is a physical supply signal, not a financial one. Third, the El Niño compound effect. Poor monsoon rainfall damages ratoon cane and discourages replanting. 2027-28 could be worse than 26-27. Okay. Okay, this is what Fryer's considering. Cane trade setup, bull call spread. Please be aware, liquidity warning. Average daily volume is less than 63,000 shares. It's a thin market. Okay, so limit orders only. Allow 1 or 2 day fill window at midpoint. Cane is the sugar fund, an ETF, not an ETN. This matters because ETNs carry bank credit risk. Cane holds deferred ICE number 12 sugar futures across multiple maturities. A smarter roll structure then substantially reduces contango drag. Current price approximately $9.93, 52-week average $8.97 to $11.63, near the lower end of the annual range, attractive for call spread entries. The January 27 LEAP option chain is live and confirmed. Critical warning, cane is a thin market. The moderate play, Fryer's preferred scenario, is the $10, $11 bull call spread. The $10 call has the tightest bid-ask. Net debit around 40 cents. Maximum profit around 60 cents per contract. Return on risk 150%. This is the sweet spot. In all cases, defined risk, doctrine compliant, thesis duration matched to January 27. Coffee, a spring already loaded. Coffee is arguably the strongest fundamental thesis in this entire presentation. We have two independent supply shocks stacking on each other. The first shock is already baked in. The 2024-25 drought across Minas Gerais and São Paulo cut rainfall by 40 to 60% below normal. Brazilian coffee output fell 8% year on year. Global stocks are now at historic lows. This is already happened. The second shock is arriving now. El Niño doesn't directly reduce Brazilian coffee quantity for 2026-27. That crop is largely determined. What it does affect, quality. The wet anomaly forecast for May-August reduces the percentage of beans that grade as export quality. Add the Robusta layer. Indonesia is the world's largest Robusta producer. Vietnam the second largest. El Niño brings drought to Indonesia and reduces rainfall in Vietnam. Both hit simultaneously. Look at the KC Arabica futures curve. It's in backwardation. Prices higher for near-term contracts than distant ones. Backwardation is a physical commodity signals current scarcity. The market is already pricing tightness. El Niño arriving on top could trigger the second price leg. Preferred contract via IBKR, the March 27, sits squarely in the 6 to 12 month lag. Coffee trade structure for the Fryer. To be clear, J.O. is gone. The iPath Series B Bloomberg Coffee ETN was permanently delisted in June 2023. There's no workaround. 3 routes to coffee exposure. Option 1 is CAFE. iPath Pure Beta Coffee ETN, volume around 6,500 shares per day, extraordinarily thin, no viable options chain, Barclays Bank credit risk, not suitable, not to be considered. Option 2, SBUX, Starbucks, my recommended vehicle for defined risk option exposure. Coffee represents roughly 25 to 30% of Starbucks costs of goods sold. If El Niño drives a sustained coffee price spike, Starbucks either absorbs the cost hit, compressing margins and spooking the market, or passes it on to consumers, risking volume. Neither is good for the stock near term. The bear put spread on SBUX for January 2027 expiry is the cleanest defined risk route. Option 3 is the purest direct ice Arabica coffee futures. KC March 2027 contract, no wrapper, no credit risk, full price discovery. If you have futures permission, this is worth serious consideration. For those holding DBA, as Fryer is, coffee is already a component. The El Niño thesis strengthens our existing position without additional action. This is what I will take. Fryer will look at Starbucks and monitor it, but happy with DBA exposure. Finish up with the double forcing function, Hormuz and El Niño. Two entirely independent forcing functions. One geopolitical, the Hormuz situation, disruptions to ammonia and urea supply, consequent fuel cost inflation and fuel cost. The other climatic, an 82% probability El Niño event disrupting rainfall patterns across the agricultural producing regions. These two variables are not dependent on each other. El Niño would be bullish for agricultural commodities regardless of Persian Gulf. Hormuz would be bullish for food prices regardless of Pacific sea surface temperatures. But both point in the same direction at the same time. Higher production costs from fertiliser, meeting lower output from weather disruption, meeting pre-existing supply deficits in coffee and now sugar. Structural convergence, not coincidence. The market, because it processes information sequentially, sees the Hormuz story and the El Niño story as separate. It has not fully connected them to the same agricultural commodity trade. That's our edge. Remember, you can print money, but you can't print oil, and you certainly can't print a monsoon. Happy trading, happy days.